Okay, hello everybody. My name is James White and I am Principal Broker of Liberty First Realty, and I'll be hosting the Avoiding Foreclosure Seminar or webinar that we are putting on today. So without further ado, let's get started. Okay, so I think it's important that we start, who I am and really do I know what I'm talking about, what qualifies me to help you folks here today. And I have 19 years experience in the forbearance, loan modification, short sales, deed and loan foreclosure arena, as well as 6 years experience directly selling homes as broker and broker owner of Liberty First Realty. Started in the mortgage industry in 1988, and I've worked for several financial powerhouses in the capacity of their loan modification departments and such, for firms such as Merrill Lynch, Wells Fargo Bank, First Interstate Bank, Bank One of Columbus, that sort of thing. What I'm not is an attorney or a tax professional, so any advice relating specific to your situation that requires reference to law or specific tax information, I'm going to ask that you seek that information directly from your professional. Okay, so what we're going to cover during this webinar are, of course, all of these topics listed here, and we'll dive into enough detail that, my goal with the webinar is to dive into enough detail so that you can make a decision on what process best suits your family's needs and utilize that process to obtain your desired outcome. At the end of the webinar, you're going to have an opportunity to take advantage of two offers that I think will provide you additional information as it relates to your situation, and hopefully you'll take advantage of those and utilize them to your benefit. All right, I'd like to touch on some statistics as it relates to foreclosures and loan workouts, and displayed here is really an alarming figure, and that is that 70% of delinquent homeowners are not in any type of a loan workout. So their path is a direct straight line path to foreclosure. And unless they do something to change that path in terms of some form of a loan workout or modification to correct that situation, their homes will be foreclosed. We hear an awful lot of statistics nationally. It's in the news constantly about foreclosures and the state of the housing market on a national level. But real estate and your home is local. And really, local statistics are what matters, and getting your loan corrected and your situation corrected is obviously of utmost importance to you. But I wanted to let you know that you're not alone. There are currently 4,500 homeowners in foreclosure in our Tri-County area, in our Portland metropolitan area, our own backyard. And in February alone, there were 214 homes that were auctioned off at the courthouse steps. Now, some of those homes reverted back to the lender. Others were purchased by third parties or investors, and no longer do these families own their own home. It's obvious that foreclosures hurt families. Just imagine having your house auctioned off at the courthouse. A new owner comes in and begins an eviction process to move you out so they can turn around and either sell your home or move into it or fix up whatever their plans are. So it has a devastating effect on families. And within these statistics, 105 homes were sold as a short sale in February. And what I find alarming about that is a workout option that's available to families, not necessarily the workout option of choice in all cases, but it's a highly underutilized workout form that can save families from foreclosure. And we're going to talk a little bit more about that later. Okay, so as we are going to start diving into the various loan workouts that are available to you, I wanted to give you a list of companies and or individuals that you might need to deal with or that may actually need to touch your loan even if it's behind the scenes and or approve or decline certain aspects of your loan workout. Not all of these individuals or companies will be involved in every loan workout type, but it's a list of those that may be available that you may need to deal with, or I, as your realtor or broker, may need to deal with as we're working through various loan workout processes. All right, so a few things that I'd like you to keep in mind as we're thinking about loan modifications and various workout solutions that we'll be going through. First and foremost, highlighted here in blue with the arrow, call your lender as soon as you're aware of a financial hardship. It is key. You do need to notify the lender. It is your obligation to do so. Let them know that you're having trouble with your payments and that you are looking for assistance and help out of this situation. Let them know that you want to keep your home and you want to do what is necessary to help work through this financial hardship that you're in currently. That being said, I'm also going to tell you that whatever and whoever your lender happens to be, if you give them a call today and you are not delinquent, even though you know within the next month you're going to fail to make your mortgage payment, don't look to them to help you immediately through this situation. Don't look to them to attempt to cure this problem or assist you with some form of a loan modification in time to keep you from ever going delinquent. Unfortunately, that just won't happen. And that's a misconception. And I'm probably the only person who's going to tell you that. If you talk to a HUD counselor, if you talk to your lender, your servicer, that's not what they're going to tell you. But that's the truth. The old adage, squeaky wheel gets the grease. Well, in this particular situation, the squeaky wheel are those folks who are the most severely delinquent and the closest to actual foreclosure. These lenders and servicers do not have enough manpower to work on every single loan that they have that is delinquent. Emotional decisions are going to cost you money, and they're going to cost you the ability to get the best outcome from a negative situation, and we'll talk about that more later. Knowing when to walk away is key. Understand that there is a time and a place for that to happen, and I'll help you understand when that is. The other factor, servicer's primary objective is what? Do you think it's to help you out of your financial situation and to modify your loan? No, it's not. What they're there for is to lose the least amount of money for the investor. The investor is the person who pays them to do their job, and their job is to service the loan and pass the financial rewards of this obligation that you have on to the investor. So they're looking out for the investor. They're not necessarily looking out for you. They're looking out for the best objective that they can put forth to the investor. So now, what's going to qualify me or you for a loan modification? And really it comes down to the first step being a hardship. And a hardship is defined as a long-term, minimum 6 months financial setback. So you will have had to experience some form of a financial hardship in order to qualify for a loan modification. And that can be, I've got some examples displayed here, a job loss, medical leave, disability. You might have death of a primary wage earner in here, might be one other example that's not displayed. So we need to have some form of physical hardship, financial hardship, to move forward with loan modification. So that's the first step. Now, if you just don't want to pay, if you're an investor in real estate and have a couple of homes and you simply just don't want to pay because it's costing you a little money, but you have the ability to pay, or as displayed here, you want to take a tour to Europe, which is a complete extreme example, but the lender is going to tell you to forget it. If you have the ability to pay, they expect that you'll do so and honor your obligation. All right, another exit strategy that's available to you is a short sale. And for those of you who don't know, what that involves is selling your home for less than you owe and obtaining your lender's approval to do just that. So there's certainly times to consider it, and it's a viable option, and I think one of the best exit strategies that you have available in terms of damage to your credit and ability to recover financially and end up with the best situation for your family out of this troublesome time. So getting into that, if you don't qualify for a modification or a principal reduction, and if you just can't bring your loan current, you're going to want to consider a short sale. Also, if you owe so much on your home that it really doesn't make sense to stay, and there's a lot of circumstances where that's true. We'll cover a few of them a little bit later, but you're going to want to consider a short sale in some of those instances. Even if you're offered a modification, it may not make sense for you financially and your recovery long term as it relates to your family and your financial position. And then, also there might be so many repairs that are required on the house that you might be able to make the modification payment that you're offered, but it might not afford you the ability to work on the repairs that are necessary just to keep the home in a livable condition. I mean, who wants to live with a leaky roof if you're able to just make the payment but you can't fix the roof? I mean, that's a problem, or you don't have a heat source or something of that nature. Sometimes it's just time to go. And when it relates to a short sale, sometimes you just need to be ready and able to make that decision, and the sooner that you can, the quicker you'll be able to recover. And then, as portrayed by the chart here, 1 in 4 homes in America are upside down in their payments or in the value of their house. So that's important to understand. You're not alone, and that short sale is a viable option under the right circumstances. Okay, let's talk about a short sale and just, really what's involved in the process. Assuming you've decided on a short sale, whether it's you who've decided or your lender has decided, here's how it works. You're going to gather the same documentation that you did for a loan modification. You're going to sign an authorization that allows me to speak with your lender directly. We're going to enter into a listing agreement, and at that point, I'm going to take over the burden of dealing with your lender and working out any of the terms of any terms of the short sale with them. So I'm going to negotiate on your behalf and work with your lender to accept less than what you actually owe. And the goal, of course, being to completely provide you with full and complete release of your debt and obligation. Meanwhile, I'm marketing your home for sale and all that goes with that. Something that's misunderstood in the short sale, and maybe why a lot of folks really don't take advantage of attempting a short sale, is that they believe that there's still costs associated with selling your home. And yes, there are costs associated with selling the home, such as realtor fees and the escrow and the taxes prorated, and maybe there's some real estate transfer fees depending on where you live and all that. But your lender or servicer is going to absorb all those costs to sell your home. So at the end of the day, when it's all said and done, you're not going to end up with a bill that you have to pay in addition to having to move from your home. So the beautiful part of this is all of this negotiation takes place, and the lender is actually the one who pays for your ability to exit your home, in the best possible way. All right, well, a very important aspect, in my opinion, of the short sale process is you being in control, your family being in control, and actually having a sense of control and some control over the timeline and what's going to take place and when you're going to exit this property. Now, certainly you don't have complete control over that through the short sale process, but in generally speaking, as it relates to all of the other options that are available to you, you have the most control when you're dealing with a short sale. And there's some responsibilities that go along with that. I'm going to market the home and everything that goes with that. I'm not going to charge you any fees up front. I'm going to negotiate with your lenders on the terms of the short sale. I'm going to keep you involved and notified at least once a week as far as what's happening, so you know what's going on. I'm going to negotiate all the terms of any offers and present them so that the lender can understand them in the format that they want, that the mortgage insurance company wants, that the investor wants. And I'm going to work with the title company to obtain the necessary paperwork, to get this transaction through as smoothly as possible. But the important aspect is that during all this and throughout all this process, you're notified of what's happening and what the timelines are, and you know well in advance what's taking place, so that you're going to know what's happening a week, 2 weeks, 3 weeks, a month from now, and there are no surprises, so that you're kept apprised of the timeline, and you can make the necessary decisions based on the timelines that are available, and you are in control as it relates to that. And what you're going to do for me is really just keep your home in showing condition, cooperate with the showings by leaving when there's a showing that's going to take place, respond to any paperwork requests that I make on behalf of the lender, or that I need to help me work with the lender and negotiate the terms, and then getting to the title company and signing when it's time to close. The other thing I'd like you to do is start saving money. It's really important. I mean, you have this point in time, this 3 to 6 month period of time, to start saving some money and getting your family in a position where you're financially able to move, and you can actually get a fresh start, so that when you exit, you have some cash in the bank and you're in a better financial position than you are today, and you're actually able to move on with your life and set yourself up for a fresh start at the end of this short sale process. And just to display a few recent completed short sales that I have, this first one sold for $252,000. The balance on it was about I think it was $340,000, $345,000, something like that. The seller received $3,000 to move and obtained full release of the debt on the first and second mortgage that they had. The second one sold for $240,000. Balance was roughly, I think it was $320 total. Might have been $360, but it was barely saved from foreclosure. The seller waited quite a long time to enter into any type of a workout situation, and we were 1 week away from foreclosure, and fortunately we were able to get that closed for them, so that foreclosure's off their record. But in this particular case, the second mortgage holder required the seller to sign a $5,000 promissory note on a $30,000 balance. So they waived $25,000, and the seller negotiated. We negotiated a $5,000 promissory note and a repayment structure on that note that was affordable to the seller. So he was able to at least clear his obligations. And third example, full release of debt, which is obviously the best scenario possible, and sold for $186,000. Non-government program, but the seller received $2,000 to move, and of course the all-important full release of debt. Okay, so as far as tax implications, we're going to get into that here now, but I just want to point out again, I am not an attorney or an accountant, so any information that you need that is specific to your situation, I'm going to ask you to please get in touch with your attorney, your tax attorney, your accountant or tax person, and seek their advice and ask them specific questions about your specific situation so you can get specific advice. So before, we have now the Mortgage Debt Relief Act of 2007. Before that, if you sold your home for less than it was owed, so in a short sale situation, let's say you sold your home for $300,000, you sold your home for $250,000, you owed $300,000 on that house, you have a difference of $50,000 that the bank wrote off or your lender wrote off. They issued you a 1099, and you get this in the mail, and suddenly you find yourself having to add an additional $50,000 worth of taxable income. Well, fortunately, due to this Debt Relief Act in 2007, you're still going to get a 1099, but you're not going to be required under certain circumstances to add that to your income, and in a sense, pay taxes on $50,000 of phantom income that you never really received. And the basic qualifying factor for this is that it's your primary residence. If it's your primary residence and you short sell your house between the years of 2007 and 2012, you're not going to be burdened with the additional tax implications of a 1099. Now, if you are an investor and you own more than one home, and the home that you are going through a short sale on is not your primary residence, that is a different situation, and you need to speak to your tax accountant or tax attorney about this particular issue. There are some codes I'm aware of as it relates to insolvency, and you'll want to ask your tax person if that actually applies to you, because you may, as a result of insolvency, not be required to pay tax on the 1099 amount or the settlement amount that is the difference between the balance you owe and the amount we sold the house for. So again, talk to your tax person about that. More information, these links are available. Hopefully they're active to you. You can get some more information on the tax code directly on my website or directly from the IRS.
Okay, well, let's talk a little bit about your credit bureau report and your credit score and what impact short sale has on that. And really, in and by itself, short sales do not negatively impact your credit at all. It's the late payments that you have as a result of your financial hardship that cause a negative impact to your credit bureau report. So just simply following the process of a short sale will not impact your credit score negatively at all. An often overlooked issue with short sales, it puts you in a position and your family in a position to buy another home if you so desire in as little as 2 years, but more often than not it's going to take approximately 3 years to financially recover enough in order to be able to purchase a home. So from an exit strategy, short sale has the absolute least damage to your credit. Two other exit strategies, deed in lieu and a foreclosure itself, are the most absolute damaging to your credit. And more often than not, lenders will not be willing to look at you in order to buy a new home for a minimum of at least 7 years. And more often than not, it's going to be longer than that. So the sooner that we can get your short sale process, the least damage that you will have to your credit bureau report and your credit score, and that shrinks the amount of time that it will take for you to financially recover from the short sale. Okay, so some further information as it relates to your credit score and credit bureau report. The Treasury's HAFA guidelines and their supplemental directive dictates how servicers, lenders, mortgage holders are to report short sales, deed in lieu, foreclosure, and so forth to the various credit bureau reports. So as you can see, in a short sale, what they're required to do is report the account as a status code 13, paid or closed, zero balance. That's the reason that short sales in and of themselves do not have a negative impact to your credit bureau report. However, deed in lieu, as you can see, is a separate status code, highly negative, and specific to deed in lieu of foreclosure on a defaulted loan. So that's why that will further impact even beyond what you've already had in past due payments. So again, that's just to point out how these are reported for a specific type of short sale. All right, so I want to talk a little bit about the emotional decision of a short sale. You found yourself obviously in a negative situation, and it makes sense that you and your family obtain the best possible outcome from a negative situation that you can, so you can financially recover in the shortest period of time. Now, using the example in the graph that we saw earlier and that's above right now, you can see that in this particular situation, for this particular home, if we take it on average, You have a $450,000 loan balance and an approximate value on the home of about $345,000. So there's a significant discrepancy between the amount that is owed on the property and the amount that the value of that particular property today. So in this situation, if you were to receive a loan modification, you have that difference of over $110,000 that you need to make up before you're in a financial position to even be able to sell that property down the road. So in a situation such as this, it might not make sense for you as a family to even want to stay in that home. Sometimes it just makes better financial sense to cut your losses, understand that you're in a negative equity situation, and that it might just be cheaper for you to rent now than it would to continue owning this home and waiting for that value to catch up with your loan balance. If we're increasing at a very nominal rate, which we are now, less than 1%, and in most cases we're declining, you can see that this period of time that it's going to take is probably, I certainly can't guarantee anything, but we're looking at least a minimum of 5 years, and I think probably longer. So you're probably going to be in this home 10 years before you start to break even again. So take a look. You've got a link down here, and what that link will do, you can plug in your home address, and it will provide to you a list of properties that have sold in the area, and won't give you an exact value, but it'll give you an approximate idea of value for your particular home in your neighborhood, and you can compare that to the amount you owe and see if it makes more sense for you to process through a short sale rather than another option. Okay, so this concludes the webinar today. I hope I've answered a number of questions that you might have had. I'd like to take some time to answer questions from the group, and if you have any, please raise your hand. You can do so in the upper right hand corner by pressing the questions button, and I'll answer as many as I can. If you have questions after the webinar, please get in touch with me. I can be reached at 503-278-5334. My direct extension is 101. You can email any questions that you have to james@libertyfirstrealty.com. And if you are in a position where you know that short sale is the best option for you and you need to move forward, let's get started right away. Delay is only going to cost you further in your credit score and your financial recovery. Thank you, and I hope you have a great day.